Welcome everyone to this week's edition of Reverse Mortgage Weekly, where I, your host, Zach Smith, owner of Chariot Financial, go over all of the, not everything, but we try to cover as much as we can in regards to the reverse mortgage program and what it is, what it's not. And really, we started this so that we could get good, solid information out there. We're not just going to cover the good stuff. We're going to cover the bad stuff too, the good, the bad, and the ugly. But I feel like you deserve the best education as possible, because that will help you make an educated decision. So let's go ahead and dive right into it here. Once again, my name is Zach Smith. I own Chariot Financial. I'm a mortgage broker. I've been in the real estate and mortgage world for 21 years now. So it's been quite a long time. You know, I went to college for restaurant resort management and got my degree from Colorado State. And here I am in the mortgage business. Went right into it. So here we go. Let's go ahead and get started here. So again, this is me, Zach Smith. I've been in the industry since 2003. I've won awards, certified senior advisor, blah, blah, blah. So who qualifies for a reverse mortgage? Well, you have to be 62 or better. So there is age restrictions for this program. 55 in some cases. There are some conventional programs that are out there that will allow you to be 55 in order to qualify for the program. Now, again, you know, some of those programs are not offered in some states, but for the most part, 62 is going to be the age that you want to be, or that you're required to be. It does have to be your primary residence. So this isn't something that you could put on like for instance, a investment property or second home or something like that. Now, you can use it to buy a second property or an investment property or something like that, but the loan itself has to be on your primary residence. Most of these are FHA loans. Some of them are, I would say, quasi-conventional because they don't go by the FHA guidelines. So, for instance, if you're in a condo complex that is not FHA approved, it's hard to do FHA loans there unless you do a spot approval, which can sometimes be a little tough. You know, we had a situation where one of our clients, in fact, we just did a video with one of our clients here about a company who said, oh, yeah, we can get it done. You're not in an FHA approved condo complex. No problem. We'll just get it. We'll just get a spot approval, bada bing, bada boo. We're done, you know. So they strung her along for 8 months. And at the end of the 8 months, they finally came to her and said, oh, well, we can't do it. And as you could imagine, she was pretty upset. So she ended up getting in contact with us. We were able to structure it correctly so that we could get it done for her. And really, you know, it's like Shakespeare said, you know, the root of all heartache is expectation. So setting good expectations with folks is really, really important, not only in my business, but every business, because, you know, we want to know people deserve to know upfront what's going to happen with their program and things like that. So if we think there's a remote chance that we may not be able to get it done, we're not going to sugarcoat it for you. We're going to tell you up front, hey, this is going to be pretty dicey. And that's exactly what we did with this client. However, under promise, over deliver, we were able to get it done. And I've always told folks that, you know, the best people that promote my business is my competition, because you do hear a lot of stuff out there about mortgage people and mortgage processes and things like that. So you have to be really thorough up front. I learned that a long, long time ago. And guess what? I learned it the hard way. So you do need equity or a large down payment for the reverse mortgage. There are minimal income qualifications. Now, qualifying for a reverse mortgage is much easier than qualifying for a forward mortgage, like a regular 30-year fixed or a 15-year fixed. Now, it doesn't mean that you automatically qualify. There are still some light qualifying. Now, for instance, keep in mind that the risk assessment to the bank, because this is still a loan, this is a loan that is administered by a bank and a lien against your property. All of those things apply. But the risk assessment with a forward mortgage is basically, you know, the bank will lend you money. You know, you ask for $200,000 for a property, they'll give you $200,000. But the first question they have is, how are you going to pay us back? And what they do is they're going to take a look at your income, your assets, and your credit. and they're going to make the determination. They are going to pass judgment on you. Yes, they are, to determine, are you a good person to lend money to? So that's what the risk assessment is with a forward mortgage. Well, with a reverse mortgage, there is still a monthly payment, but that payment is optional. So if there's no monthly payment that's required, what's the risk assessment? Well, there's two factors involved with that. One, current rates. These are still just like a mortgage product. They are governed by current rates and CMT index in particular. The other risk factor is how long are you going to be in the house? I always tell people that, the second I turn eligible to get a reverse mortgage, I'm running down to the bank to get one. So let's say I'm 62 and I run down to the bank and get my reverse mortgage, and I reverse mortgage, we'll say 200,000 just for round numbers. And I put that in a position where I'm no longer required to make that monthly mortgage payment. Well, let's say my mortgage payment is $2,000 a month, which is really, really low for rates these days. But let's say it's $2,000 a month. I've got $200,000 balance. Let's say, God willing, I live to 102. Well, I would have lived in this property without making a mortgage payment for 40 years. So there's a pretty good chance that I could be upside down, or that loan balance is going to balloon to a high amount of where the property balance, or where the property equity is at. So what that means is that a person who is 62 can borrow less than someone who is 82 with a reverse mortgage. So just keep that in mind when you're thinking about this program. That is how they assess the risk, is the current market conditions and your age. So again, this is more information about the reverse mortgage. It is administered. Most of these programs are administered by HUD, and they call them a HECM program, which stands for Home Equity Conversion Mortgage. According to the U.S. Department of Housing and Urban Development, and this number has been increased. There's several million people right now that have a HECM right now as a reverse mortgage. The amount of money available, again, is determined by the age of the youngest homeowner, the current interest rates, and the value of the home allowed lending limit. The index is based off the CMT again. So what are the benefits of the reverse mortgage? Well, one, you do get to keep the title to your house. There's a myth out there. People think, oh, you're giving up the home to the bank. That couldn't be further from the truth. If that were the case, anyone who had a mortgage is doing the same, because it's the same as any other mortgage. If you put a 30-year fixed loan on your property, you have a lien against the property, and technically you own the property. You're on the books at the county. But if you don't make your mortgage payment, the lien holder has the ability to take your home, to foreclose on it. Same thing with the reverse mortgage. And now, except for the foreclosure process, of course, there's really no foreclosure process for the reverse mortgage because there's no required monthly payments. That's another myth that we run into, is that people think, oh, the bank's going to take your house. I had an agent call up the other day. I teach classes for the state here in Colorado for real estate agents to educate them on this program. I am trying to get on my soapbox and tell everybody about it. Why? Because I've seen what it's doing for my clients' lives. So I had an agent said, oh, she had a reverse mortgage, and one of her clients called her. It was the daughter, and her mother had passed. And they said, we're a little bit concerned. We don't want to tell the bank that she passed, because then they're going to foreclose on the house. And I was just thinking to myself, oh my gosh, I really need to do what I can from where I'm at. If you can't do big things, do small things well. Some of you might know who said that. But so I'm thinking to myself, gosh, I really need to get out and educate people, because this is the thing. Once you're no longer living in the property, so if it is basically you pass or you go to an assisted living facility, basically what will happen is that your heirs will have 6 months to determine what to do with the property. And then you can also request 2 free 3-month extensions on top of that. So the heirs will have an entire 12 months, if they choose, to determine what to do with the property. You are not going to find that with a normal mortgage. On a 30-year fixed or a 15-year fixed, once you stop making those payments, you're getting a call from the bill collector saying, hey, You missed our payment. Where's it at? And just so you know about those payments on a 30-year fixed, most people are paying 50% of the interest up front in the first 10 years of those amortized payments. So it's there's a lot to be said about that. I'll try to keep it concise, but most of your mortgage payments go into the bank in the first 5 years. You're handing your retirement, you're handing over your hard-earned cash right to the bank. Well, a lot of my clients take a look at that and they say, well, gosh, instead of handing over my hard-earned cash and interest that I'm paying to the bank, why don't I just put it in my pocket? That way I can direct it. That way I can put it into another investment. That way I can have a better quality of life. So it's one of those things where, it's cost first value is really the conversation that I think a lot of people need to look at when they're just deciding, is my quality of life worth more than passing on more equity? And what does your family want for you as well? So keeping title to your home, that's something that is an advantage of the reverse mortgage. Basic credit and income qualifications. Again, it's a light qualifications, and monthly payments are optional. You still have a monthly payment. Now, a lot of folks look at the reverse mortgage, and one of the things that a lot of people say about this you're going to go upside down on your house. You're going to go upside down. Well, the thing is that that's what everybody sees the result. But the thing is that that's a choice. There are monthly payments. If you want to make a monthly payment and treat this just like a normal mortgage, you can. But the thing is that you're not forced to. If you have the funds to make the monthly payment, you want to pay your mortgage down, you want to pay interest to the bank, you can do that. You can do that. But if you say, you know what, it's Christmas, or, it's holidays, or I have a trip coming up and I just want to save this money this week, well, you don't have to make that monthly mortgage payment. It's not required. For instance, I had a client just a few years ago. She had lost her husband a few years prior to us meeting. And, she had about $15,000 in her savings. She was 68. She loved her house. She had a beautiful rose garden in the front, all kinds of different colors. I mean, it was gorgeous. She loved her house. She did not want to go anywhere. Well, she was in a pickle because she wasn't making that much with her Social Security. So her income was not very high. So what she ended up doing, she had about 15,000. She started off with about 150,000, but she started using those funds to live off of. When I met her, she had $15,000 in the bank, and she was taking money out of her savings every single month so that she could make her mortgage payment. That is a recipe for disaster, and it's something that we see every single day. Real estate is one of the biggest assets and best assets that you can have, because guess what? We all need a roof over our head. So normally what happens is people will exhaust their entire life savings, and then they're stuck. They can't make their mortgage payment. And then what happens is they sell the property and they go rent somewhere. And like I tell my first-time home buyers in their 20s, just starting off, if you're paying rent, you're still paying a mortgage. You're just not paying your mortgage. So basically, she was taking money out of her savings every single month so that she could make her mortgage payment. Again, that's a recipe for disaster long term if you want to stay in your home. So what we were able to do is to convert her current mortgage into a payment optional program. So now, instead of those savings coming out of her savings account, instead of the money coming out of her savings account, guess where it's going? It's going the other way now. She's starting to save money. And I've got a great diagram that will go over that information here. And this is the 3-bucket theory, 3 buckets of finance. You have your income, the red bucket, your assets, and your home equity. Well, these are just the state of affairs. A lot of folks are not saving enough for retirement right now. I won't bore you with the details here because everybody knows this. I mean, just looking at this, less than 26% of people surveyed said they had less than $1,000 saved for retirement. And the Americans that are saving are not saving enough. So basically, these are the 3 buckets of finance. So pre-retirement on the left-hand side here, you can see you have your income, you have your assets, and you have your home equity. So pre-retirement, basically what's happening is that the income from the red bucket, you're working, it's going to save in your 401k, your assets, and then you're also going to you're also putting paying down your mortgage for the most part. So pre-retirement, that's what that looks like. Now, if you look at the visual to the right, these buckets change in retirement. In particular, the first bucket, a lot of times we're not working as much as we did in our youth. So we're on fixed incomes, we're on pensions if you're lucky. You know, a lot of our politicians decided in the 70s and 80s to gut the pensions from the American people. Why? Well, it's a little more profitable for companies to do that. And they said, hey, here's your 401k. Good luck. Well, pensions are a great way to retire. You get guaranteed income. Um, but anyways, I digress. We'll leave the we'll leave that conversation for another day. So as you can see, the red bucket, your income bucket shrinks, usually because you're on a fixed income. Well, the second bucket, that yellow bucket, it's in a throne in the second position, in the second visual there, because it becomes vitally important. And if you don't take my word for it, go ahead and call up your financial advisor and ask him how important your assets are and why they're starting to plan for people into their hundreds, living into 100. It's like the Smucker's commercial, where they show the birthdays of people over 100. Well, 20, 30 years ago, you'd watch it and you'd have probably, three or four people on there. Well, now if you watch that Smucker's, you've got, 10, 15, 20 people deep on that, turning over 100 Centaurians. And it's a really good documentary on Centaurians on Netflix if you guys are interested. Just a little tidbit. But that bucket becomes very vitally important, mainly because the biggest fear that a lot of my clients have is they don't want to run out of money in retirement. And it's a real fear for many people because we don't know how long we're going to live. We don't know how long we're going to need those funds. So preserving your assets as long as possible is really one of the main features of the reverse mortgage that is not talked about enough. So basically, preserving those assets becomes vitally important. That's why we've put it in the throne. Well, you've got the third bucket there is your home equity. Well, the home equity is just kind of sitting there. You've paid off a majority of your mortgage in most cases. Some may or may not have, maybe still have a mortgage, but your equity is just kind of sitting there. And the thing about equity is it's great to have, but it's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. So, you're sitting there, watching your favorite show, kick your feet up on your coffee table. Oh, look at all that equity I got. Well, if you can't get to it, is it really valuable? It's not like we can take a picture of our house and go down to the grocery store and pay for our groceries with it. They might look at you a little funny if you try to do that. So equity is great, but we can't eat equity. When you need the cash in retirement, you need to be liquid. You need to be able to get cash out of the bank so you can go buy your groceries, so you can fix your car, so you can go on a trip, or you can pay for medical bills. Well, if it's locked up there in the house, you can't get to it. It doesn't help you out. It's kind of like folks who buy house cash. Now, again, I'm going to be the first one to admit that I'm biased about this. The guy who makes a living by lending money to people on their real estate is telling you it's a good idea to take a loan out on real estate. Oh, go figure that, right? I am biased with this, but this is the way I look at it. People who are buying, I don't think it's a great idea to buy a home cash. I really don't. And a lot of people like that. They will cash out on their previous residence, say $400,000. You put it down on a new property, 100% cash. You don't have a mortgage payment. with seniors. I mean, just the home equity right now is. Okay, we're going to see if we can get back to this here. We're having some technical difficulties here. It's been real cold here in Colorado, and we're having issues with our internet. And I call the internet company up and I say, hey, we're having some issues. I'm not getting, our internet is not working right. Oh, everything's fine. Everything's fine on our. Like, okay, I guess it's fine. Well, we're back, folks. I don't know what happened there. I don't know if you're just staring at me trying to figure this out, but we're back here. It looks like. So let's talk a little bit about equity. So what is equity? It's cash that's not accessible unless you sell or take a loan out to pay back with interest. Again, I don't know if you caught my little spiel about paying a house cash. Well, if you buy a house cash, you take that money, let's say it's $400,000. You take that $400,000 and you hand it over to a bank and say, hey, can you hold on to this for me? Or you give it to a buyer and say, hey, can you hold on to this for me? Because if you want to get that $400,000 back out after you put it down in cash, now, if you don't need the $400,000 and you don't need it at a later time, no worries. If you're, it's kind of like, so, I'm in Colorado. So there's a lot of people in the cannabis industry in 2012, 2013 that just had a ton of cash because they were operating these facilities that would sell cannabis, but they couldn't put any of the money in the bank because it was from a federally deregulated substance, marijuana, cannabis. So they're sitting on all this cash. Well, what do you do with all that cash? Well, you go out and buy real estate with it. So that's one of the things that is the bad thing about paying cash is that if you want that money back, you got to call a buyer or you got to call a bank. So you kind of hand that cash over. Whereas if you took that $400,000 cash, took out a reverse mortgage for $200,000, put the other $200,000 down on that property. Well, now you're in a situation where you've accomplished not having a mortgage payment that's required. Now, if you want to make that mortgage payment, you can. But if you choose not to, if you don't want to take your hard-earned cash and hand it over to the bank and interest, then you can take the other $200,000 and reinvest it. You can put it wherever you'd like. You can direct it. But it's in your hands, in your bank account, in your pocket, in your control. Now, if you put it into the property, you don't have any control over it anymore. You're kind of at the whim of where the market is going to go with real estate. And, I'm biased. I've been in the industry and I've seen real estate change people's lives. It's changed my life. So real estate's always a good investment. It's always long-term. But how you leverage the real estate can really help you move through things much better, increase your wealth. And that's really what the reverse mortgage is about. It's about passing on a higher net worth, not so much more equity. Because 9 times out of 10, when someone passes, what's the first thing that the family does? Well, they sell the house. There's sometimes people want to keep the house or move into it, and you can still do that with a reverse mortgage. It's not a problem. You just pay off the existing balance, and the folk, your kids move in or whoever. But 9 times out of 10, people will sell it. They want the cash. They want the equity. They don't want the actual physical property. So does having equity in retirement really benefit you? Not really, because it's not liquid. Again, you can't go down to the grocery store with a picture of your house and say, hey, I got this whole cartload of groceries. Here's my house. just I'm good for it. It doesn't work that way. You can't eat equity. You have, it's like that glass coffee table right there in the middle of your living room full of cash that you can't get to. So is it better to pass on a higher net worth or more equity? That's really the question. So what do people usually do with a home that's bequeathed? Again, they sell it. So does cash do better in your pocket or locking it up in your home? That's really the question that a lot of us have to answer. And after seeing, and this is something again that I get on my soapbox about, is a 30-year fixed or a 15-year fixed. For that matter, any amortized loan, you're paying 50% of the interest on a 30-year fixed in the first 10 years. The deck is stacked against the consumer when you look at a amortization schedule. So for instance, I have first-time home buyers, say they take out a loan for, here in Colorado, pretty easily 500,000, for starter home these days. So they take out a loan for 500,000. They look at the truth in lending statement that says, oh, you're going to pay us 800,000 for this 500. Well, how does that work? Well, they're going to charge about $300,000 in interest, depending on where the interest rate is at. And guess what? You're going to pay us that $300,000. You're going to pay 50% of that in the first 10 years of the note. So the deck has always been stacked against the consumer when you look at amortized loans. That's why I'm a big proponent of the simple interest loans, because you pay your loan off much faster. You pay it directly to principal. So if you have a windfall, you pay money down on the home. Well, your payment goes down the next day. You don't wait for that amortization. You don't let the bank dictate to you when to pay the loan off. It puts you in the driver's seat. Again, I digress. But people look at those kind of stats and they say, look, I'm not going to hand over my retirement so that it can go into the bank's coffers. I'm going to keep those funds. Instead of making that monthly mortgage payment, I'm going to put it in my pocket. And yeah, you're paying a little interest, but you're paying it with your equity. You're not paying it out of pocket. There's a huge difference in cash flow when you do that. So why are people taking these out? I mean, what's the benefit? Well, number one, we just hit on it, increased cash flow. That is the number one reason people are taking out the reverse mortgage. We had a gal, again, I have so many stories on how this has changed people's lives. She couldn't retire because she had a mortgage payment. She had to work. And she was working in the grocery store, which was considered in the dark days of the pandemic an essential worker. So she was terrified every day going to work. She was a florist and she hated it, but she felt like she had no other option. She felt like she was trapped because, she'd go to the bank, walk in the door. Hey, I want to refinance my home. Well, you don't qualify. You don't have the credit. You don't have the income. Again, the risk assessment on the reverse mortgage is completely different. So she was able to qualify for a reverse mortgage. We converted her current mortgage into a payment optional program. So now she doesn't have to crack that nut every single month to come up with that payment. Well, guess what? Now she can retire happily in her house and never have to worry about making a mortgage payment for the rest of her life. That's how this program is changing people's lives. So number two, asset protection. This is something, again, that's not talked about with a lot of folks. People think that, oh, this is a program of last resort. You only use it if you have to. Not at all. People who own their homes free and clear are taking these out because you have a line of credit that you can get to. Now, isn't it much better to reach into that line of credit instead of reaching into your assets? One of the questions that I ask people when I teach my classes is, I tell them I have a suitcase full of cash here for you, $1 million. But I also got this magic penny that will double every single day for 31 days. What do you want? You want $1 million cash, or do you want a penny that doubles every single day for 31 days? Well, most people, like me, I'm kind of a dummy, to be honest. And I took the cash. Give me the $1 million. Well, you don't want the $1 million. You want the penny, because the penny, after 31 days of doubling, it's going to be worth $10 million, over $10 million. Go ahead, do the math. 1, 2, 4, 6, 8, 10. It doubles to about $10 million. But the thing is that if you take that penny out at 15 days, you're only going to make about $100. So that's just an overly gross example of how compounding interest works for folks. But the point I'm trying to make is that in retirement, instead of taking money out of your retirement account, out of your penny that's doubling, take it out of your home equity. And guess what? Your retirement assets are going to last a lot longer. Well, our half hour is up here, so we'll go over the rest of this on our next presentation. Once again, you can always contact me any time of the day. We work 24 hours a day, 7 days a week. You can visit us at Happy House Today to see other presentations that we've done in the past. I try to do this every Wednesday for a half hour, just to get the good word out to people about the reverse mortgage program. So if you have any questions for me, feel free to give me a call here or visit our website again, happyhousetoday.com. Hope you have a blessed rest of your day, and may blessings rain down on you like 1,000 suns. Thank you so much.